So I just want to welcome everybody. Well, obviously I know all of you, but I want to welcome my life students back. This is phase 2 of our training session, and we're going to focus on Annuities 101 today. Okay? I was going to not allow any of my life students into the room unless you had a life application since the last class, but I decided not to. But I'm going to give you guys another week, okay?
We're doing our contracting.
Okay. Excellent. Love to hear that. Again, welcome. This is part 2 of our training session, and Josh Hoffman will be conducting the annuity training class. Without further ado, I just want to say again, thank you so much for coming, and I want to introduce my son, Bill, to the group. Bill?
Okay. Great job.
Okay, thank you.
Okay, all right, what we're going to do, and by the way, you see Oscar's here recording all of this. We have a lot of agents that wanted to be here that obviously we don't have the room for everyone, so we're going to record this for an hour. We're going to start with Chris, who is an annuity expert, consultant. He is, when it comes to annuities, he's the man. So he's going to start off with probably, what, a 20-minute little spiel. We're going to talk about how to bring up the annuity sale, just like an annuity overview, 100-foot overview. As soon as he's done, Josh is going to take it from there and make sure everybody's comfortable with the website, with quoting, where's forms and brochures, basically everything that you will need to know to go out and be dangerous for annuity sales. And Josh is also your resource here at Levinson. If Josh is tied up for any reason, Joe is a great backup, and he has access to everything if needed. So he's also a great person to get to know on the annuity side. Okay, so we'll start with Chris, and then as soon as he's done, Josh, you'll take over, and then we'll wrap it up at the end. Okay? All right, and thank you everyone for joining us.
Thank you, Bill.
Yeah, nice to meet you. You too.
Okay, Chris, if you can hear us, you're good to go.
All right, guys. Thank you very much, and good morning, everybody. Big thanks over to Carrie, Bill, Joe, Josh for having me on this call today for this kind of Annuity 101 presentation is how they were telling me we're kind of situating this whole thing. And folks, I just want to tell you, I work with a lot of annuity agents, from brand new agents who are very green with annuities, all the way up to seasoned veterans who have been doing this for years and years. And I always find that agents who are trying to get started in annuity sales always make things too complicated on themselves. And even more, they often feel intimidated by the products, the process, and the conversation when it comes to annuities. And it's pretty understandable, right? If you think about it, it can seem like a daunting thing when you're just trying to get started with annuities. But at the same time, it can be extremely valuable for you, the agent, and your client to start having that annuity conversation. And think about it this way, folks. If you're having that, if you're an agent and you go into a house and you talk to someone about life insurance, you make that life insurance sale and you walk out of the house, to that client, what are you now? What's the client going to consider you? They're going to consider you the life insurance agent, right? If you go in the house and sell a med sup and you don't bring up anything else and you walk out of the house after that med sup sale, what is that client going to consider you? You're the med sup agent, right? You just handle those med sups. But if you start talking to your clients about annuities, you start talking to your clients and taking an interest in their savings, their future, their retirement, you become that client's all-around agent for all of their needs. You're having that conversation with them about their future, about how they're going to about how they're going to retire, and more importantly, how you can help them get there as well. So to really help with the products, the process, the conversation, when it comes to fixed annuities, we created the 5-4-3-2-1 method here. And folks, can you see that on your screen? I'm thinking that's popped up on your screen just fine for you. Yes.
Excellent, excellent. So the 5-4-3-2-1 method is here. And folks, before I start going into this a little bit, again, I created this to just help with the products, the process, the conversation. Don't make annuities this intimidating, scary, complicated thing. They really do not have to be that way. And of course, if you do have any questions on annuities, Josh Hoffman's a great resource for you when those types of questions arise. But with that, I created the 5-4-3-2-1 method to really help get started and start that annuity conversation. For example, let's start off with number 5 here. 5 benefits to fixed annuities. 5 benefits to fixed annuities. Now, folks, before I get started into this, there are a lot of benefits to fixed annuities. There are a lot more than 5 benefits to fixed annuities. But if you're getting started in annuities, this is a great base. You just have to know like the back of your hand. If you know these things and that you start talking to a client, even on the street, on the golf course, and you just mentioned that you do fixed annuities, here are some benefits. These are 5 big ones to know for you. Let's start off with liquidity real fast. 5 benefits to fixed annuities, starting off with liquidity. If you're talking to a client, a lot of times you're going to get one big pushback whenever you're talking about annuities. And you're going to have the Suze Ormans, the Dave Ramsey saying that there's no liquidity, but that's just not true. There are surrender penalties with annuities, but many contracts allow penalty-free withdrawals, allowing your clients to have access to up to 10% of their money without any type of surrender charge, penalty, anything like that. There's a lot of liquidity involved. Levinson & Associates, they even have products with as much as 50% liquidity, even 100% liquidity with some of these products. So if your clients have a concern about access to their money, there are products available for that. The second benefit here, growth potential. Folks, the growth potential of annuities is outstanding. Growth with interest credits based on the performance of an external market index. What are we talking about when we say that? We're talking about fixed indexed annuities. You have a lot of growth potential to work with the market, but of course, not take any of those drops in a down marketplace. And that brings me right into principal security there. Low risk with minimum guaranteed value requirements. You will never lose your principal if your contract is held for the full term. Folks, think about it. If you're 30 years old and the market drops 20%, it's not a big deal. You have a lot of time to invest for the future to make up for those losses that you just took. But let's say you're 65 years old. You want to retire in a month. The market drops 20% on you out of nowhere. That's a very scary thing. You've lost a lot of your nest egg that you were hoping to retire on. Well, with fixed annuities, the great benefit of these fixed annuities, that principal security, probably my favorite feature. As long as your clients put that money into the plan, they keep it in there, they don't take any surrender charges or anything like that, that principal is going to be safe. One of my favorite benefits there. Of course, income. Income is one of the big benefits to fixed annuities. Folks, this is entirely unique to annuity contracts, that ability to annuitize your contract for a guaranteed stream of income. An annuity is the only product available where you can annuitize it based on your life expectancy. It's a huge, huge feature with annuities. And of course, finally, tax deferral. Tax deferral, this doesn't get talked about enough. We have some outstanding charts. I know Levinson & Associates, they have some outstanding charts that can talk about tax deferral and the benefits for you against CDs and those other types of vehicles. Annuities earn compound interest on a tax-deferred basis, folks. What does that mean? That means interest on top of interest on top of interest, just growing for you with fixed annuities. Folks, again, 5 benefits to fixed annuities. If someone asks you, hey, why should I look at a fixed annuity? You have liquidity, growth potential. You have your principal security there. You have the ability to annuitize and take an income for the rest of your life. And then, of course, you have that big benefit of tax deferral that you can't get with other vehicles like CDs. So, folks, that's number 5 there. That is 5 benefits to fixed annuities. Let's hop over to number 4 real quick on the 5, 4, 3, 2, 1 method. 4 questions to ask in every appointment. You go into an appointment and you just want to start digging in. Maybe you're there to talk about life insurance. Maybe you're having a completely different conversation altogether. What are 4 questions you can ask in every appointment? Let's start off with this top one here. Mr. Jones, are you happy with the current rate of return on your CDs, savings, or money market accounts? Are you happy with those returns that you're getting on those CDs or money market accounts? What are those returns that you're getting on those money market accounts? What are those returns you're getting on your CDs? A very simple question to start getting your client thinking about what they have currently, right? If your client has $100,000 sitting in a CD getting 2%, well, guess what? You may have access to an annuity that can get them 4% instead. That's an easy sell. Why wouldn't a client go for that, right? Ask about those CDs, money market accounts, and savings. Second question here, are you concerned about outliving your retirement income? Are you concerned about outliving your retirement income? It's an important question to ask because many people don't think about this. They think, hey, I've been saving, I've been putting money away into a 401k, into a plan at work, I've been getting contributions from my workplace. But Mr. Jones, are you concerned about outliving your retirement income? How long did your parents live for? Are you planning on retiring at 55? Well, you know, if your family has a lot of longevity, you might want to make sure that that money can last you for your entire retirement. It's an important question to ask. And of course, I love this next question. Do you want your income in retirement to be guaranteed for the rest of your life? The power of annuities, that one benefit that we just talked about, that ability to get that income, to annuitize. You can guarantee your client that they can get an income for the rest of their life from their retirement fund. Do you want your income in retirement to be guaranteed for the rest of your life? And then finally, my favorite question on here, Mr. Jones, how would you like to protect your retirement money from market downturns today? What does that hit on for you? That hits on that principal security benefit from the 5-6 benefits there. How would you like to protect your retirement money from market downturns today? That principal security feature and outstanding benefits so your clients don't lose their money in retirement. Folks, that's 5 benefits to fixed annuities, 4 questions to ask in every appointment. Now let's take a look at number 3 here. I like this one so much because we just want to keep this very simple. If you're a new agent on the phone, you're on this call, you're in that room right now, 3 products that are out there for annuities. It doesn't get more complicated than this. For fixed annuities, you have fixed index annuities, you have traditional fixed annuities, and you have SPIA products. Those 3 products can handle a lot of needs for your clients. You have your index products with that growth potential in the marketplace. You have your traditional products that can match up like CDs. Those traditional products say, hey, we can give you 4% for 5 years while this CD is giving you 2%. A very simple conversation. Or let's say you have that client that says, look, I'm retiring in a month. I need to take my 401k. I need to put it into something that's going to start to pay me an income for the rest of my life. Well, that's where a SPIA comes into play. That's where a SPIA comes into play. And folks, again, like I said, it doesn't get much more complicated than that. Josh and Joe have some outstanding tools to help you out with these 3 different products to help you differentiate what's going to be the best fit for your client. As we take a look at number 2 here, so we're already down to number 2, the 2 needs, folks, the 2 needs. Anytime you're talking to clients, you have to build a need, right? You have to build that need. If you're talking about life insurance and you're talking to a 20-year-old kid, he's probably not going to have a need for life insurance, is he? He's a single guy. He's not going to need life insurance. But if you start to build that need for someone on why they need something, you're going to have a lot more success out there having that annuity conversation. And when it comes to fixed annuities, there are really 2 needs out there that are going to stand out more than anything else. Income or accumulation. Income or accumulation. What is your client looking for? Are they looking for income or are they looking to just accumulate funds? Whenever you're out there talking to a client, ask them, you have $100,000 sitting here. Maybe they're 50 years old. They don't really need the money right now. Sounds more like an accumulation need. Or maybe they're 65 years old, like the example I just used. They're about to retire and they're going to need an income coming from their 401k in the next 30 days. Maybe that's where an income product is going to start to fit into their needs. Whenever you're calling Josh and Joe, asking for those types of quotes or asking them for something, know the need of your client. What do they need exactly? How old is your client? How much do they have in this account? And most importantly, what is their need? That's where Josh and Joe can really start to tailor fit those products for you. The 2 needs, folks, I can tell you this much, it really doesn't deviate much from those 2 needs right in front of you right now. Income and accumulation. Those are the 2 fixed index annuity needs that you have. And finally, there's really one solution, folks, to all of this, and that is fixed annuities. If you're having that conversation with somebody, you're talking to them about their retirement funds. You're talking to them about what they're looking to do in retirement, how they need to save, what kind of income they need to maintain their lifestyle. Maybe they just need to park some money because they got this $100,000 sitting in an account. Maybe it's earning nothing sitting in savings. Well, would that money be better served sitting in a traditional annuity that could at least earn something for them, and then in the future they can decide what they need to do with it then? Absolutely. A lot of problems can be solved. A lot of solutions are out there when you start to have that annuity conversation with fixed annuities. And folks, that's really my 5, 4, 3, 2, 1 method there. And again, I know Josh is up next here. He's an outstanding resource. He knows these products back to front. He's definitely going to be able to help you folks out on the call right now.
Okay. Thank you, Chris. Appreciate it. Okay, and this is the Annuity 101 Basics course. And we have this, I can send this to anybody who needs it. And what we want to cover in this course are what are fixed annuities. And, I think Chris did a pretty good job of explaining what they are, why a client would need a fixed annuity, how tax deferral works, and the different types of fixed annuities. Okay, so let's start out with what fixed annuities are. If you sell life insurance, you can kind of think of fixed annuities as a mirror image of life insurance. Because why do people buy life insurance? They buy life insurance because they're afraid they're going to die too young and leave their beneficiaries without their income. The reason people buy annuities is because they think they're going to live too long. And the thing is, you have a limited pot of money, and what do you do to keep from outliving that money? And annuities are the answer, because there's no other investment that guarantees you, regardless of what the actual performance is, that they're going to provide you with an income for as long as you live. And that's become very important today, because for one reason is that people are tending to live much longer than they have in the past. And it is a growing industry. There were $60.9 billion of annuities sold last year. If you think about that, it's a big number.
60.9?
Billion.
60.9?
Billion with a B, yeah.
Mm-hmm. Wow.
Josh, can I ask you a question?
Yeah.
Just step back on the income. So are you referring to an income rider, or are you referring to just annuitizing?
Right, either one. There's a lot of different ways to get income. And, you're absolutely right. Without getting too much into the weeds, there's, what are called SPIAs, which I'll get into a little later. And what SPIAs are sometimes called old style annuities. Basically, the person gives up their money to the insurance company. They never see the money again, but they're guaranteed an income for the rest of their life. Those have dropped in popularity in recent years, but there are still people who like the idea and would rather have an income guaranteed for life and have that pot of money. We do still sell SPIAs. And a lot of it depends on what your customer wants. And there's also what's called annuitization, which is a similar idea to SPIAs. The difference between an annuitization and a SPIA, you're buying an actual product where you're giving them money now, and it's producing income. What annuitization means is that you buy an annuity, deferred annuity, you keep it a few years, liquid, where you have access to the money, and then you give the money to the insurance company to give you a monthly income for life and lose access to it. Now, an income rider means that the company is guaranteed to give you a certain income for the rest of your life, but if God forbid you need that lump sum that's still left, or whatever money's still left, you have access to it. And the advantage to that is people are living longer today than they used to live. And a lot of times people need to go to these assisted living places or nursing homes, and they want $100,000 or $200,000 or $300,000 admission fee, and getting a monthly income doesn't do that for you.
So if you put your rider in force,
Mm-hmm.
and let's say you're getting your income for a couple of years, and then you decide, okay, I need
Yeah.
100,000.
Yeah, for the admission fee for, XYZ and assisted living home, you could do that. And that's a big advantage. And, I'll get into a little bit later, there's advantages and disadvantages of both SPIAs and annuitization usually pay a little bit higher than income riders as far as income goes. But they don't give you the flexibility of taking out the lump sum.
Right.
Mm-hmm. You have the income, but you're going to get less because you're taking
Exactly.
money out.
But you can go back to income after you take out your money, right?
Yeah.
Is that right? Okay.
That is correct. Okay. Yeah, and as I said, they've done $60.9 billion of new. So this is a huge market. Regulations behind this for now. During the Obama administration, they were talking about having the federal government regulate annuities. It was called the DOL because the Department of Labor was going to be in charge of these regulations. And basically, in the last 2 years, they've decided not to do that for a lot of different reasons. First of all, because insurance is regulated at the state level, it would be difficult. And, the other reason is that basically what we're selling are not securities products. And even though it's the Department of Labor doing this, they basically wanted to put under the auspices of the security regulation, that the security regulation would be supervising the insurance agents. And, basically, they kind of figured out it didn't make sense because insurance agents, by and large, aren't securities licensed.
Put a little damper on our business. Yeah.
Yeah, and there's a growing market. Right now the baby boom generation is getting to retirement age. And, what happened in the baby boom generation probably about 30 years ago was our parents or grandparents generally got pensions. Their employer would set up an account, they'd retire, they'd get a certain amount each month. About 30 years ago, most private employers at least changed from pensions to 401ks. And so what happens is now these people have been saving 25, 30 years in a 401k, and they have this pile of money, usually $100,000 to $500,000, and they don't know how to use it to generate a retirement income. And that's where annuities really come in. And that's where you kind of become more advisors, because somebody 60 to 70 years old comes to you and says, can I retire? And what you can show them is if they put this money in an annuity, how much retirement income they could generate. And the thing about annuities, as we've been discussing, is you do have a lot of options. If the FIA income rider doesn't produce enough income for you to live on, you also have the choice of going to a SPIA and giving up some of your liquidity but getting more income. So there are a lot of different choices. And this is the slide that Chris had up before. These are the real advantages of the annuities. You have liquidity. And this is very important because you do have people like Dave Ramsey and Susie Orman who are going on TV and saying, don't buy annuities, you lose your liquidity, which isn't true. And I think in a sense they're committing malpractice because not everybody belongs in the Fidelity Growth Fund. And that's what they're implying. Maybe your 25-year-old who's just starting to save does, but your 60-year-old who's close to retirement may not be able to take the risk. And that's the whole thing is that yes, you are giving up the liquidity to come in and get your money tomorrow, but what you're getting in exchange for that is your principal is being protected. Granted, if you put the money in a mutual fund, you can turn around tomorrow and say, give me my money back, but the catch is you may not get all your money back. The growth potential. And again, without getting too much into the weeds here, all the annuities we sell are fixed annuities, but they all calculate interest in different ways. And what Chris was talking about at what he actually called fixed annuities are annuities that pay a fixed interest rate for a fixed period of time. like for example, we have one 5-year annuity now that pays 4% for 5 years.
Who is it? Just
Sentinel.
Okay.
And, we have, and if somebody's in a CD at 2%, that's going to look pretty good. Right? Now we also have, fixed indexed annuities are really fixed annuities, and a lot of agents get confused about that. Because even though your money is going into allocation, usually the S&P 500, the worst you're going to do is 0. In other words, a company is agreeing to pay you a fixed interest rate. It's just that fixed interest rate is based on the performance of the S&P. You're not directly buying shares of the S&P 500. And that's why they're not securities products. Principal security, and again, as I said, not everybody belongs in a mutual fund, not everybody belongs in the stock market. That's a big advantage that, you're not going to get a 20%, gain some year when the stock market's booming, but you're not going to take a 30% loss either. Your principal is always protected. And they avoid probate, which is very important. And we find this even sometimes with wealthier people. Not everybody has a will. And a lot of middle class people don't think about wills because they don't have a huge amount of assets. And even some wealthy people don't do wills. And if somebody is in that situation of not having a will, they don't have to worry about probate with an annuity because the money goes directly to the beneficiary.
Can you repeat that?
Yeah, the money and the annuity will go directly to the beneficiary that you name. So, if somebody for some reason doesn't have a will, they don't have to worry about it going through probate. Yeah. Now, tax deferral is another thing that's great about annuities and where they beat CDs. Because when you buy a CD, even though you're committing to 3 years or 5 years or 10 years, whatever you're committed to, the bank is still going to send you a 1099 each year for your interest. And with annuities, now this part you have to kind of pay close attention to. They are not tax-free, but they are tax-deferred. And what that means is during your accumulation period, as long as you don't take money out, you don't pay taxes. When you take money out, it does come out on a gain first basis, but depending what you do. In most cases, it comes on a gain first basis. The only time it doesn't come out gain first is if you annuitize, and then they calculate what part is gain and what part is principal. But if you just take regular annuity withdrawals, it comes on a gain first basis.
So you'll be paying tax. That is part of your income.
That's part of your income. That's part now. Yeah, and I don't want to get into that right now about qualified and non-qualified money, but I will get into that later. And tax deferral, is basically about what we call non-qualified money, which means money the person had in a bank account saved, that money they saved after taxes. And here's where it makes a big difference. Let's say you're actually paying your taxes from a CD rather than paying it out of pocket. And you have that same money in annuity. Well, if you take the money out of the CD each year to pay taxes, you put in $750,000 in year one based on a 5% interest rate. After 5 years, that annuity is going to have $957,000. That CD is going to have $895,000. So even though you do have to pay taxes in the end, having the tax deferred accumulation really does help you accumulate more money. Okay. And also you control when you pay the taxes, which is important too. Because what a lot of people will do with annuities is defer the money until they're retired and in a lower tax bracket. With CDs, you don't get to choose when you pay the taxes. If you're working and you're in the 25% tax bracket, you're going to pay 25% taxes. Immediate annuities, and this is what I talked about before. These are the old style annuities. And they give you a few different options. One is what's called period certain. And a lot of times people will buy these to fund life insurance policies. And, rather than giving you a payment based on your lifetime, they'll pay for 10, 15, 20 years, whatever period you choose. Also, a lot of people who retire young, are trying to bridge a gap between when they retire and when they start collecting Social Security, and that might be a way to do it. But what's usually most popular in the SPIA is what we call life contingent. And life contingent means no matter how long you live, they're going to pay you for the rest of your life. So basically, if you live to be 110 years old, they're going to pay you till you're 110 years old. Now, there are a few different variations on life contingent payments. There's what they call straight life, which is not all that popular. It provides the highest payment possible, but the downside is you get hit by a bus the day after you buy it, the insurance company is keeping your money. Then there's life with period certain. So in other words, they're saying, okay, we're still going to guarantee to make payments for as long as you live, but if you happen to die, let's say 10 years, in the first 10 years, we'll pay the remainder of the first 10 years of payments to your beneficiary. And at least that gives a person some, if they do die in the first year or whatever, it gives them some guarantee that the company is not keeping all their money at least. And then there's what's called installment refund or cash refund. And what those two mean is that, let's say you give them $500,000. Installment refund means they're going to keep paying your beneficiary installments after you die until $500,000 is paid back. And lump sum is almost like a life insurance policy. Lump sum basically means if you die, they're going to give the beneficiary the difference between what you paid in and what you gave out in the check. And obviously, the better the guarantee you get, the lower your payment is going to be. Let's get the few there.
Josh,
Yeah.
I'm probably going to word it incorrectly, but is there any advantage to doing a single premium immediate annuity over a life insurance policy where you do a lump sum one-time pay?
Yeah, the big advantage is guarantees. If you do an IUL and use an IUL for income, there's no guarantee you're going to get the income that's projected. In fact, in a lot of cases, there's no guarantee you're going to get any income. It's all based on performance. With the annuity, you're getting a guarantee. And I know these IUL illustrations look great on paper where they show you're going to make $50,000 a year when you retire. But, when you look at IUL illustrations, there's 3 columns in them. And if things go south, you may not get any income. And I'm not saying they're a bad thing. What I'm saying is a person should probably be diversified and be prepared in case there's some years of bad markets.
But as far as the illustrations on IULs, don't they account for those bad years with the
No, they don't. Unfortunately, in their infinite wisdom, the government doesn't let you do that. What you're talking about, they call it Monte Carlo modeling in the business, where they can show ups and downs, but the government doesn't let you do that. Insurance companies do it internally. That's the whole thing. They make you pick an interest rate, 6%, 7%, whatever, and assume the market's going to return that every year. And then on the downside, you assume the market's going to return 0 every year. Then some of the illustrations will have a midpoint too. Now, traditional fixed annuities, which are multi-year annuities or markets, they're going to give a certain return for a certain period of time. It's usually 3 to 10 years. And that question comes up a lot. Can my client put money away for 1 year? Can they put money away for 2 years? And the answer is no. If annuities are kind of a long-term investment, so if they're going to do it, they have to be willing to commit to 3 years or more. And do they have access to their money? And again, you can't have it both ways. You can't say I want to make 3 or 4% of my money and have total access to it, because that just doesn't exist out there. But you do have access in the sense that they will give you a 10% free. Most of the products will give you a 10% free withdrawal each year. Some, a lot of it, you have to be careful what you see. A lot of times when you see these real high fixed annuity rates, it's because they don't have a 10% free withdrawal. And again, the people who want these are the same people who invest in CDs, and they want them for the same reasons.
Josh, I don't know if you have ever heard commercials from Anthony Perry.
Yeah.
I don't, years already on the radio.
Uh-huh.
So, he talks about the same, I guess the same annuity all the time, where 20% bonus and first year or guaranteed 6% for this long. And do you have any idea what?
Yeah.
I get people
When they
that
talk
ask me
about that, they're usually talking about income riders, not about actual accumulation.
Okay.
And when I get into indexed annuities, I'll talk about it, because generally the fixed annuities don't offer income riders.
What's with the 20% bonus?
Well, that's usually on the income base too, not on the accumulation.
Okay.
And just over ahead of myself here, but when I talk about index, I'll talk about the difference between income base and accumulation. And fixed indexed annuities aren't that different from fixed annuities. As I said, you're still kind of earning a fixed interest rate, but it's going to be based on the performance of an index rather than the company just saying you're going to get 3% or you're going to get 4% or whatever the company decide. Clients only share in the gains and not the losses. So and that's the advantage over mutual funds and variable annuities. That if the market is negative, the worst you do is zero. And the way they can afford to do this is because they either cap you on the upside or limit how much you're going to participate. So in other words, they're going to say, no matter what the market does, you're not going to make more than 4 or 5%. And then, or they're going to say, yes, you'll participate in the S&P, but only 55% of it, not 100%. And it kind of makes sense because they are, nothing in this world is free. And that, cap or the participation rate is a price that you're paying to be protected from the downside of the market. So in other words, they're taking the hit in the bad years, but they're getting, a certain percentage of the profits in the good years too. Now, premium bonuses. A lot of annuities have premium bonuses, and they're kind of all over the map with that. They range from 3%, some numbers actually as high as 12%. And, I'm not a big fan of premium bonuses for this reason. And a lot of people like think those are safer money in the bank. Generally, there's an inverse relationship. When you get a big premium bonus, your caps are going to be lower. There's an old saying, there's 100 pennies in a dollar. Right? Mm-hmm. And, but where premium bonuses are very helpful when you're out on the field selling, is that a lot of people bought annuities and, may think they're the wrong products, may not be happy with the performance, whatever the reason is, and want to look at other annuities to put money into. And a lot of times if they bought them within the last 5, 6, 7 years, they're going to have surrender charges. And getting back to what I was talking about in the beginning about the suitability. One of the things they look for in suitability is that if you're replacing an annuity that has surrender charges, you have to do what's called making the customer whole. In other words, you can't have the customer take a loss to do a transfer. And the bonuses kind of solve that problem. Or they do solve that problem. And
You can.
Yes, in other words, if they have a 5% surrender charge, let's say, you can sell them a product that has a 7% bonus, which will wipe out the 5% surrender charge. Yeah, and and the other thing is some people, aren't 100% sold on market performance. And getting that 7% up front, in their minds, they think, even if the market does nothing, I still got my 7%, or my 10%. And, typically, almost all index products have a 10% free withdrawal. And, that's 10% free withdrawal is usually one of the big selling points. Because that's usually what holds people back from buying annuities. What if I need my money? And the 10% free withdrawal is how they get it if they need it. Okay, and when you sell indexed annuities, you have to understand what a stock index is. A stock index is these companies, like S&P, for example, aggregate diversified stocks into a group of stocks they feel reflects the market in general. And these indexes are popular with insurance companies because, without getting too much into the weeds, to have people invest in indexed annuities, they don't actually have to buy millions of shares of stocks. They can buy futures on these indexes. Which, if they did this with individual stocks, would be much harder. And there are different ways they measure these indexes. Probably the simplest is what they call a 1-year point-to-point with a cap, which basically means they're going to measure it from February 1st, 2019 to February 1st, 2020, and then whatever it does. Let's say you have a 5% cap. If it does 10%, the company's going to pay you 5%. If it does 5%, the company's going to pay you 5%. And daily average means they look at each day what the stock market did, up, down, and they average out the 300 days or so a year the stock market is open. And then again, that's also usually subject to a cap too. And then whatever it did, they'll put that against a cap and give you interest. 1-year monthly average participation means they'll take the average of the performance over 12. They'll see what did the market do in January, what did it do in February, what did it do in March, and average those numbers, positive and negative. And and then apply a participation rate to it. So that's an example of an uncapped account. So if the participation rate is 50%, they would give you 50% of what it actually did. And then again, 1-year monthly cap. 1-year monthly cap is the same thing. That's sometimes called monthly sum. They add the performance of the 12 months together. And 2-year monthly average is the same thing, but they do it for 2 years. And that's becoming more popular in indexed annuities. A lot of them will offer you higher participation rates for doing 2-year accounts. And then I guess it kind of comes down to how sophisticated your clients are. Obviously, if you only get paid interest once every 2 years, your client's taking more risk because the market can go up 1 year and down the next. But if they're willing to take that risk to get a higher return, and again, these 2-year point-to-points usually illustrate a little bit better than 1-year point-to-points. Okay, and here's an example of a 1-year point-to-point. He started in January with the S&P being 100, and these are just hypothetical numbers, not real. But then he ends in December with it being 107, so he made 7%. And then, based on whatever his cap is, if his cap was 7%, you get 7. If his cap was 5%, you get 5.
And if it was based on participation rate, it would just be whatever.
Yeah, so let's say it's 50% participation, you get 3.5. Yeah. And usually on S&P, participation rates do run, I would say, depends on if there's bonuses and whatnot, but they do usually run between 40 and 60% on S&P. Okay, now again, caps are the upper limit which is applied, which and basically that's how a lot of indexed annuities work. Now a lot of them are moving more towards these participation rates because interest rates are starting to creep up right now. We've been in a low interest rate environment for a while. And, you know, a lot of people, that's a big objection, you know, they don't want to do it for 3 or 4% interest. And the participation rates are kind of the way they answer that objection, saying, okay, you know, if you really think it's going to be a hot market, we'll give you 50% of what the market does rather than a 3 or 4% cap. Okay, so again, and this is an example of what we just looked at before, the 7% and the 3.5 cap. Even though the market moved up 7, if the person had a 3.5 cap, they'd only get 3.5%. Okay, and again, what we're looking at with annuities is number one, the safety of principal. You're not going to lose any money. And there's really no other investment that can say that. That can say, no matter what happens, you might get 0 return, but you're not losing money. Tax deferral, again, it's one of the few investments out there, you know, for any kind of money. I mean, for IRAs, there's a lot of different investments you can tax defer the money with. But for just after-tax money you're taking out of a bank account, annuities are one of the only investments where you can put it away and not pay any taxes until you take it out. Guaranteed lifetime income, and that's a big one. You know, and that's what people really want. You know, my wife manages a doctor's office, and she sees people every day walking to the office, 90, 95, 100 years old. And maybe 20 years ago you didn't see that. You know, and this is the trend for the future, you know, they're making medical advances every day.
Did you hear about the cancer thing today?
Yeah.
Israel?
Yeah.
Did you hear?
Yeah, they're making these big medical advances every day, and
In Israel, they think that they found literally like
a cure for
a
cancer.
cure for cancer, and
America's not going to put it out. It's just
well, no.
too much money.
But they said that, you know, it's called whatever, I forgot, but they're going to be testing on specific cancer types, but they feel like it's going to be a few years yet, but they're thinking it's there.
Yeah, I mean, that's exactly the thing.
It's all over the place. Today.
Like in my parents' generation, you know, if people made it to 75 or 80, they were lucky.
Right.
Mm-hmm.
You know, but in our generation, who knows, we might make it to 100, 110. You know,
if there's no cancer, we could be, you know, at 150.
Yeah, and that's one of the reasons it's a growing market, because there are a lot of people out there who are living to older ages. And the seniors, and I mean, you sell annuities to people any age, but, you know, in truth, the seniors are probably going to be your biggest market for annuities. You know, the seniors are the ones with the retirement money, and they're the ones who watch interest rates very closely, and they're the ones living on the fixed income are very interested in anything that's going to increase that fixed income. And again, you know, you are participating in the stock market. You're just not getting 100% of the gains.
Or the loss.
Or the loss, exactly. Okay, and you know, basically that is what Annuities 101 is. Basically, you know, from 10,000 feet up, it's a simple sale. You know, basically you have people who have money, but don't know how to turn it into income. And that's what you're doing. You're showing them a way they can get a lifetime income from their money, and that they can't outlive. Or you're showing them a way, if they're a little younger, to put their money away and be able to save it on a tax-deferred basis without having the friction of paying taxes every year, and being able to accumulate more, and probably more importantly, control when they pay taxes.
Could I'm assuming that they're still exempt from creditors?
They're still exempt from creditors, yeah.
Okay, so that, you know, I mean, some people find that to be
They're still exempt
a
from,
good thing.
They're still exempt from creditors. You know, the only caveat I'd put on that is going back to the suitability. You know, if somebody is in a position where they don't have assets, it's probably, or their assets are negative, it's probably going to be hard for them to get approved financial underwriting wise for an annuity.
Yeah, not people necessarily that are having issues, but you never know, you know, you could get sued, whatever, you know.
I have a client who asked me about a
Variable.
Variable annuity.
But
How do I sell against that, Taste?
Well, the thing about variable annuities is variable annuities are not protected against market losses.
Right.
Now, I know some of the companies out there do kind of market them like they are, but they're really not. Like I worked for MetLife for a long time.
Right.
And MetLife used to sell the idea you can't lose a penny in a variable annuity. Well, what they were really saying is if you bought the income rider, you were guaranteed to get all your money back as income. They're not saying if you decided to cash it out tomorrow.
You could lose part of your principal.
Right. You could lose part of your.
There's no protection against. Although, don't a couple of them now have
Well, some will sell what they call high watermark
Right,
riders,
right.
which basically means when you hit a high watermark, you can lock that amount in.
Right.
Okay.
But you
For the
do
most
pay,
part.
but you do pay extra for those riders, and usually it's a percentage of assets, and they're not cheap.
But of course, then you have the advantage of possibly
Gain.
gaining.
Yeah, you get getting it. Yeah.
It's like being in the stock market as far as I'm concerned.
Yeah, and
62.
and I think with a 62-year-old, what you really have to say is, do you really want to watch whatever fund the money is in every day?
Right, and he's a health client of mine, a health insurance client, and I don't know how much money he really has. He claims millions, but he wants to do an annuity, so.
Okay.
And he focused on, I think, the variable.
Yeah, because he went to some dinner
like a
seminar thing, and
seminar.
it interested
Okay.
him in it as well.
All right.
Yeah, and I think the advantage of the index over the variable is obviously the zero floor.
Right.
And that's the thing. Everybody thinks they have the stomach for the market.
Right.
And that's what a lot of these guys depend on. But you get people in their 60s and 70s that are looking at that stock page in the newspaper every day.
Oh yeah, he told me how he lost, when the market, back in December when I saw him, the market turned, he lost 500,000, like immediately, so.
Right, but you have to really
Yeah.
have the stomach for that.
Yeah.
Yeah, so you really have to say, do you have the stomach for it? Do you have the stomach if we have another 2008?
Right, right.
And 2008 was an anomaly. It happens. It doesn't happen that often, but it does happen. It happened in '87. It happened in the mid-'90s when the internet bubble burst.
Right.
So about every 10 years, something like 2008 does happen, and corrections are a normal part of the market. Now, if it's a 30-year-old client, say, fine, put your money in the market, all ups and downs, you'll make money in the end. But with a 62-year-old client, if the market has a crash in 2 years and he loses half his money, when is he going to make it back?
Right. Will he outlive the money? Will he live long enough to make it back?
Yeah.
Quoting, like if you have a client, you have to call you to get a quote for an annuity, or how do you quote somebody?
Yeah, right now you'd have to call me. Unfortunately, there really is nothing like high pipeline for annuity quotes right now. We're hoping something like that comes up in the future. Basically you have to run the quote off the carrier websites. And, if you call us, we will get the quotes out to you. And I think in a way it's a good thing because with annuities aren't like buying a term policy. It's not just this annuity is going to give you, a 10,000 a month, 10,000 a year income. This one's going to give you 10,200. There's a lot of other factors that people are going to look at with annuity besides that.
I have a question.
Uh-huh.
If I have a client that says, I'd like to receive $1,200 a month in income, can you back it out and say how much the deposit would be?
Yeah, we can do that, especially with SPIAs, but we can do that with.
No, I mean with like an income.
We can do that with indexed annuities
Yeah.
too. Yeah, and as I said, right now indexed annuities are really the more popular way to do it for a couple reasons. One, from a selfish point of view, as agents, indexed annuities are going to pay you much higher commission than SPIAs. SPIAs generally, depending on the carrier, are going to pay 2 to 3%
Variable
commission.
annuities also are on the low end, right? Those are,
Well, yeah, variable annuities, the thing is, most of the people selling variable annuities are selling them through a broker-dealer.
right?
And some of them are wrap account brokers, and some of them are, still very few of them, but there are still some brokers out there working the old model. But
They make less on a variable.
yeah, and that's the thing is, I think it's a heart-to-heart with your client.
Yeah.
Do they really want to take market risk?
Okay.
How are they going to feel if, they lose half their principal?
Right.
You know, and like I said, I don't think variable annuities are probably the best thing for older people.
Okay.
You know, if for somebody in their 60s or 70s, you know, they take a 50% hit like 2008, you know, realistically they're not going to make it back.
Right.
Uh-huh. You know, I think variable annuities are probably better for somebody in their 30s or 40s who might have left a job and left a 401k behind and, you know, has 20 years till retirement.
Okay.
Mm-hmm.
Good.
But yeah, so that's the thing, you know, and you know that clients want everything, and then I think part of the job as an agent is to help them set reasonable expectations, you know, make them kind of come to grips with what kind of risk they're willing to take to get returns.
Okay.
You know, everybody thinks they're going to buy Apple or Microsoft, or you know, but for every Apple or Microsoft, there are 100 startups that fail.
Right.
Mm-hmm.
Very true.
But you know, and that's the thing. You know, most people, you know, they want it all. They want to get 10% and have no risk and get a huge income.
And liquid.
You know, it's just not the way products work. It's not the way any product works.
It's not the reality.
It's not the reality. Yeah, yeah, and you know, basically, to get something, you have to give up something.
Right.
And with annuities, what you're giving up is some liquidity.
It's like being married, right?
Yeah, yeah, and
We know that.
Yes.
you know, you're giving up some liquidity, you're giving up some market gain for the safety of principal. You know, maybe that's not for everybody, but at $60.9 billion market, a lot of people like the idea.
Yeah, definitely.
Josh, I don't know if you were planning on going into this. What about like when you're presenting the illustration to your client?
Okay, when you're presenting an illustration, one thing I really like about indexed annuities as opposed to variable is a lot of things on the illustration are guaranteed, such as the income. You know, so you can say you're absolutely guaranteed to get this income. What's obviously not guaranteed is the returns. You know, and illustrations do show that. Most illustrations have two parts. They have a guaranteed illustration of whether the market does nothing for the next 30 years, and then they have one based on the historical performance of whatever your index is, usually the S&P, but a lot of the companies have been going to these boutique indexes.
Yeah.
You know, a lot of them have been going to ones from Barclays and Merrill Lynch and different houses. And part of the reason for that is a lot of the companies own these funds. Mm-hmm. And you know, the thing with S&P, or you know, usually they have to buy futures for S&P, so you're going to get less participation. As I said, usually S&P, depending on the product and bonuses and different factors, is usually going to be between a 40 and 60% participation. Where some of these boutique funds, like we have one carrier who does 105% on Morgan Stanley Diversified. We have another one who does Merrill Lynch with a 1% spread. You know, so the advantage of some of these ones that aren't S&P, which may not be as well known, these indexes, are a lot of times you will get higher participation on them. But, you know, I think the thing with annuities, it really comes down to the fact finding. Mm-hmm. You know, when you're in a house, even if it's younger people, you know, you want to ask them, you know, how long have they been in their job? Not really that you care so much how long they've been in their job, but you want to find out, did they leave another job? Did they leave a 401k behind?
Yeah.
You know, you want to ask them, you know, as Chris said, how do you save money? Because when you talk to seniors, I'd say 7 or 8 times out of 10, it's going to be CDs. You know, and then obviously your follow-up question is, well, how much are you getting on your CDs?
Right.
You know, and so as Chris said, it's usually going to be, you know, if they have that kind of access to jumbo CDs, it's probably going to be 2 or 2.5%. Mm-hmm. And you know, if I give you 4% instead of 2%, would you be interested? You know, that's the easy sale. You know, and again, you know, when you do your fact find, you want to ask them what they've done for retirement, how they're planning for retirement. You know, and that's going to lead you into the annuity discussion. as I say, because a lot of these people have been saving in 401ks for 20, 30 years at their job. They have hundreds of thousands of dollars in their 401k, and they don't know how to turn it into an income. You know, and annuities are the way they can turn it into an income. You know, and as I said, you know, it comes down to reasonable expectations. You know, if they've saved $100,000 in a 401k, they're not going to have a $20,000 income for the rest of their life. You know, and we hear these discussions that agents have with people every day.
But they have to roll it from the 401k into an IRA, don't they? In other words, the
Yeah,
401k is not-
yeah, the annuity would be classified as an IRA, as an IRA, yeah.
Okay.
And
So they have to roll it.
they have to roll it.
Direct it, yeah.
Yeah, and usually we do a direct transfer just because it's cleaner for tax reporting.
And it's quicker.
It's quicker and it's cleaner. Yeah, because the problem is if they go to their employer and get a check and do it in 60 days, they wind up with 3 and 4 tax forms and it gets complicated.
They have too much time to change their mind. They look at the
Yeah,
check and it's like-
Yeah, when it goes directly from one company to another, you know, the tax reporting is all done by the 2 companies and the client doesn't have to worry about it. But yeah, so basically that is what happens. Is they roll it from one company to another. And when you do it, there is a suitability form too. You know, as I said, they're going to ask their total assets, their liquid assets, their income, you know, if they expect their living expenses to change, if they have enough money to live on. And it's also, yeah, this is a very important thing. It's also going to ask you advantages and disadvantages. And you kind of have to go into home office mode, not salesperson mode when you see that. Because I know a lot of agents will jump and say, oh, there are no disadvantages, and that's the wrong answer, and it's not going to go through suitability if you do that. The disadvantages are the liquidity, that you're giving up liquidity. You know, and like I said, you know, when you do suitability forms on annuities, you do have to answer all the questions. You know, and that's part of what selling them is. And, you know, and it's also being honest with your client. That, you know, the annuity is what it is. You are giving up access to that money to get future income or to get higher returns. You know, and but there are lots, you know, that being said, there are a lot of clients out there who are going to have no problem with the suitability. You know, we're going to have enough assets to do it and who need the income. And we deal with about 30 different annuity companies, you know, and a lot of them have specialty provisions. We have a few that actually do long-term care. And now, just so you know, as I said, most annuities are not underwritten for health. Long-term care annuities are. You know, and they're underwritten pretty much the same way that long-term care standalone policies are. They do a phone interview and a prescription drug check with the person. And an MIB. And so long-term, and that's another misconception you run into. A lot of people think long-term care annuities are for unhealthy people. They're not.
It's the opposite.
We're still not going to get it.
Yeah, exactly. There is underwriting for long-term care annuities. And we also have annuities which have death benefits. And I wouldn't necessarily sell them to the sickest of sick people because there are provisions in there to protect the companies. But if you do have somebody who is not in the best health but not on a deathbed either, it's an option. You know, generally what they'll do is guarantee them a certain amount of return on a death benefit. Like, for example, one of the companies we work with is Great American. And they have a rider that says no matter what the actual annuity does, they're going to guarantee you a 7% return on the death benefit. We work with another company called Phoenix.
Annual simple. Okay.
Yeah. We work with another company called Phoenix, which actually does 10% on the death benefit. You know, and you know, it is a way, like I said, it's not necessarily for people on death's door, but it's as a way for people who might not be in the best health to get a death benefit if they can't get life insurance.
Because that one's not underwritten.
That's not underwritten.
You just pay for a rider?
That's not underwritten, no, but like
Or
I
is
said,
it's,
like I said, for example, the Great American one doesn't pay the enhancement if you don't live for 5 years. They give you back the rider charge, but they don't pay the enhancement. Now, Phoenix is probably the most liberal one. Basically, you only have to live the 1 year to get the 10% credit. You get the 10% credit. Yeah, but they all kind of protect themselves. You know, somebody's going to die tomorrow. They're not going to get anything special out of it. But yeah, so, but you know, that's basically what it is. And you know, you guys don't have to memorize all this, obviously. You can call me when you have an annuity question. And, but you know, just, I think the big takeaway from this should be when you see a client, when you do your fact finding, you know, bring up annuities, bring up retirement savings, bring up how they save money. You know, bring up when they left their last job, did they leave a 401k behind? You know, because these are all sales that you might be leaving on the table.
Right. No question.
Mm-hmm. Okay, does anybody have any questions? Yep, that's it. And, you know, I think y'all have my number.
Yes.
So,
Thank you, Josh.
thank you.
Yeah, thank you.
Thank you.
So when was that?
we have to